Push play. Okay. All right. Can we get Christy and Brian put your videos on for me real quick? All right. Make sure everyone's got some notes, some paper to take some notes and some pen. All right. Look at Brian's setup, man. He looks like you look like you're in the lobby of a fancy hotel, my man. All right. So the training class today, we're going to go over probably one of the more important parts of a presentation. It goes over the list of concerns and building the need for life insurance for them. Okay. This is a very important part because this is the transition to where we went over term and whole in training on Monday, right? Showed you guys how to be professionals, how to look like and sound like and act like you know what you're talking about, right? Because you could break down their coverage here and show them a good plan and everything. And if they don't respect you as an agent, if they don't think you know enough, they're not going to even worry about what this says, right? Yeah. So that's why we show ourselves as the expert first, describe the different types of life insurance to them, make sure they have a good understanding of that, and then they're able to then we're able to break down their coverage for them because we're experts at that point. All right. So after we go over term and whole with them, the transition there is now I'm sure you guys, have some benefits at work, right? And, every single year there's what's, contract negotiations and benefit changes, right? And, it seems like right now that we're starting to give more and get less, right? So, the union members like yourselves, there was a big concern for permanent benefit programs, and your labor advisory board came to our company, and the reason why we exist is to make sure that you have those concerns and problems taken care of, right? So before I even get into this, guys, I want to make sure you have an understanding of like what the labor advisory board does, who they are, right? So each union, right, has a union president. How do you think that union president gets there? Do you think they just rise to power? Do you think that it's like a patriarchy where they got to be in the family to keep that name, right? How do you think that they get into that position? Time? Okay. They're actually voted in. Oh yeah. Right? So they're voted in, right? Union members, all the members of their union votes in their union president, right? So if their union president isn't doing the right things for their members, do you think they're going to give votes? Probably not, right? So their union president approved our program for their members. They're not going to approve anything that's bad for their members, right? So first off, we got to make sure that they know that, right? So the labor advisory board is made up of 50 different union presidents. Here they all are. All right. They're not all the unions we represent have a union president on the board, but a lot of them do, right? A few of the cool names on here. Some of you'll realize still a Jimmy Hoffa on the board for the Teamsters, right? There's been a Jimmy Hoffa on the board for the Teamsters for the last almost 100 years. Okay. One of the biggest unions we presented are Teamsters unions, right? Started right here, Chicago, right? That's pretty cool. So you got to think, guys, the Teamsters union basically built America.
Real quick, did you watch that movie on Netflix?
I did.
Man, it was great.
I did. Irishman?
Yeah.
Yes.
Loved it.
I paint houses, right? So, but yeah, I mean, if you guys have 3.5 hours to spend, take a look at The Irishman. It's a pretty cool movie. It's about, Jimmy Hoffa and all the things that he did to get the Teamsters union started and how they kind of built America, basically. They used a lot of the money that the Teamsters got in to build buildings and give people contracts. And, actually the Teamsters basically built and the mobsters basically built Las Vegas, if you think about it. Yeah. Right. They used all the money that they laundered and cleaned to build Las Vegas. Right. So there's a very, very strong history of union members in America. Back when our company started, there were about 20% of America was unionized, only about 20%. It's right about the same now, maybe 20 to 30% are unionized. But that's still a very big demographic. When Bernard Rappaport created the company, he thought, hey, am I going to be the one company that represents 20% of all of America? Or am I going to be one of the 1,000 companies that represent 80%? right? So he took the route less traveled, right? We only really represent union members, associations, and families. And then through the outreach programs, we're able to take care of child safe members and WILCIT members as well, right? So, but the Labor Advisory Board, the reason why I'm showing you this, guys, if you look at the Labor Advisory Board, there's a couple names you're going to notice. Denise Boyer, right? Denise is head of our PR, basically, right? She started here in Illinois, guys. She's on a Labor Advisory Board for our company. Another big one, you know, Roger Smith, used to be the CEO, right? So Roger Smith is on there. Big influence with American Income. And then, of course, Steve Greer, right? The current CEO, right? So these people on the Labor Advisory Board, what they do is they get together every year and they make decisions about benefit programs that best help their members out. So they're not going to, like, these unions don't like flip through a page, like a white pages and say, oh, we're going to use this company to represent our members. No, they sought us out because we're union members as well, right? So the whole reason why I'm going over the Labor Advisory Board is we want to make sure we mention that to them, especially with our union members. So guys, you know, the next benefit, the last no cost benefit they had set up for you was your needs analysis, right? And you know, we've all gone through benefit changes and contract negotiations at work, right? And it seems right now that we're starting to give, you know, a lot more and get a lot less, right? So, you know, what your Labor Advisory Board did was get together with, you know, the heads of all these unions. And what they did is they came up with a big list of concerns for our company to protect, right? Now, we took that big list of concerns and we brought it down to about 6 different areas, right? And the first concern, right, every single time, you should mention this every single time to them, the first concern that our members brought to our attention was permanent and portable benefits. Benefits they got to keep even though they left. That's the whole reason our company exists, right? You should mention that like 2 or 3 times during the presentation. You should mention it at the beginning. You should mention it when they have work coverage during the family information guide, and then you should mention it here too, right? Making sure that they know that, yes, you probably have great benefits through work, but they're not permanent, right? Our benefits are permanent whether you quit, fire, retire. That's why we're set up, right? Now, the second concern a lot of our union members have is final expense protection. Making sure that their funeral is not a burden to anybody down the road, right? Now, when we're going over this with them, if you're doing it virtual, like I know everybody on the screen here is, I know my team doesn't really use a whiteboard like this. We have it in the PowerPoint, right? You can draw on the screen, right? I saw Christy drawing on the screen earlier today, right? That's perfect. You could still do that. This is the area we're going to be breaking down their coverage and what it's going to recommend for them, right? Now, the more and more presentations you're in and the more and more presentations you do, you'll know what the needs analysis is going to recommend for them. You'll be able to kind of figure it out and feel your way through everything, right? But if you're just starting off, you want to use very basic numbers here for them so they understand it, right? Now, like I said, the first concern is final expense protection. One thing I want you to keep in mind here when you're going over all of these concerns is questions sell. So I want you to ask them like as many questions as you can here. Right? We got to figure out what's going on with their situation. To effectively help them, we have to use active listening. Right? It means if I ask them, Joe, have you ever, you know, experienced a funeral before? You know, it goes into a funeral. And he's like, yeah, you know, my mother just passed away about a year ago. Oh my God, Joe, your mother passed away, you said, a year ago? Wow, I must have taken a crazy toll on your family. Did you guys have any life insurance set up for that? Right? I'm just digging for some more information for him, right? Using the last thing he said as the first thing I say, right? It shows them that you're paying attention to them and you're really going over their needs, right? So first question I typically ask them with final expense, I say, Joe or Mary, you know, have you guys ever had to deal with a funeral before? No. Have you ever had to plan one? No. Do you know how much a funeral, you know, a funeral costs nowadays, right? That should be your first question. You guys know how much a funeral costs nowadays?
Yes, for me, like.
No, I'm just saying hypothetical. I'm looking at you because the camera's like right on you. But typical final expense protection, right? Nationwide average. Now, if you ask people that question, you'll get people to say, yeah, it's probably like 10 to 15,000. They're going to generally be pretty close to be honest with you. You might have some younger people say, oh, I don't know, pretty expensive, like 35,000, 40,000, right? Yeah. I mean, yeah, it's going to be right there, once you're looking to use it, right? But you can just tell them, yeah, it's going to probably be up there at some point, but right now it's about 10 to 15, right? So even if they're way completely off, don't go, nope, that's way wrong. It's not 50,000, it's 10 to 15, right? Or if they say, oh, like 3,000, yeah, you're pretty close. You're pretty close, right? So I always tell them, nationwide average for a funeral is anywhere from $10,000 to $15,000, right? That's now 10 to 15,000, right? Now, what I usually do with my members is I project backwards and then forwards, especially if they're in their like mid 30s, 40 years, like definitely prime age for life insurance. Even if they're in their 50s, 60s, it doesn't matter. We can go back in time even further with them, right? So what I always say is that nowadays is about $10,000 to $15,000, right? But if we went back, just 20 years, it puts you like, let's say this person is, I don't know, let's say this person's 40 years old, right? If they're 40 years old, project back 20 years. So 20 years ago, when you were 20, we're looking at probably at, anywhere from about $5,000 to $10,000, right? For the same funeral. But just like your milk, your eggs, your bread, and your gas, right? Every 20 years, prices are doubling. So 20 years down the road, we're looking at about 10 to 15,000, as opposed to 5 to 10. Right? And you're only 40 right now. You're in pretty good health, right? Okay, great. So, you probably got at least 20 more years in you, right? Hopefully you got 40 years left in you. That's only going to put you at 80, right? So project out further down here. So down the road, we're looking at about 20 or 30,000 for that same funeral, and if they're in their 30s, like if they're in the same age bracket you guys are, project out further. Keep projecting out, because it's going to happen, guys. It's not like it's not going to happen. Like if you look at gas, like I'm 33, right? 10 years ago, gas was probably like $1.25, $1.10 a gallon. Fast forward 10 years, it's $3. Speedway's right there. It's $3 for a gallon of gas. And that was just 10 years, right? Now, gas prices are a little more volatile in the market, so it's not really great to compare them to, but people understand gas prices. It's a simple thing that you can compare it to, That's what we're kind of trying to do. The whole overall thing here is painting them a picture using common items, because using tangible things. Like life insurance is not tangible. Like, yeah, you can hold a policy in your hand, right? But it's a feeling, it's an emotion, right? It's like if you, Tommy used this example the other day. If you had like a little guy outside your house, right? Every single morning you gave that guy $5 and you knew that your family was protected, right? Would you give that guy $5 every day, right? And didn't have to worry about anything at the house, right? So that's a tangible situation where you're actually handing money over, right? But you don't have any like proof or tangible proof that that things are being taken care of, It's not like you buy a vacuum cleaner and you could physically see the vacuum cleaner things up, right? It's a little bit different. So it has to be a feeling, it has to be an emotion. You have to get them involved. You have to paint the picture. So, at this point here, you're projecting that the same funeral cost $10,000 to $15,000 now. It's going to be 20 to 30 or 40 to 60 down the road, right? And I mean, if they want to go cremation route's a little bit cheaper, right? Cremation probably, I don't know, I'd say probably like 3 to 7 nowadays. Project out 20 years down the road, we're looking at 7 to 14. Even down further, we're probably looking at 15 to 30. So still anywhere from 15 to 30,000, right? And to be honest, cremations are becoming very popular. There's a lot of things you can do once you cremate the body. You can turn it into a diamond. You can bury it and plant it as a tree, right? There's a lot of different things you can do. So just like with anything that becomes popular, what happens to the price of it? Goes up, right? Supply and demand, right? If there's less supply of it, there's more demand, the price is going to go up, right? So if cremations are going to be in high demand, then the price is going to go up for sure, right? So there's, and when I go into the final expense with them, you know, I always tell them, you know, there's a couple of different things that go into a final expense. It's not just what happens at the funeral home, it's afterwards too, right? It's spending money to get things cleaned up at the house. It's spending money at the wake, spending money, you know, getting your family all there, right? All the extras, right? So there's what's called variable costs for a funeral and fixed costs, right? So variable costs for funerals or you know, processions, things like that, is anything that's not like set in stone. So it would be like flowers, right? It would be like how many cars they need in the procession, you know, the gas for those limos, how many people they have to hire as ushers, right? How long you got to be in the facility if they're being laid out for 2 days or 3 days, you know, there's a lot of stuff that goes into that, guys. That's a variable cost. Depends on how many people are going to be there. Depends on how many hours you want to be there, right? There's no fixed cost for that stuff, right? So when if you ever run into somebody that's pre-planning a funeral, and they're like, yeah, I prepaid my funeral. Well, this is what they're not prepaying for. Because every time they, even though they did pay $9,000 for their funeral, let's say that they don't die for another 20 years. It's not going to be $9,000 anymore. It's going to be like, you know, 18 to 20,000. So, and the reason why is because these variable costs are always going to increase. Now, there's fixed costs as well. Fixed costs are things like, you know, grave markers.
Even those are going up.
Right? And, you know, like land, so plots. And those two things are really only the goal fixed costs. Maybe the casket if you buy it of hand.
Depending on what religion you
Or urn, something like that, you know. If you prepay for things like that, those are physical things they can't take away from you.
Yeah.
Like if you get a plot for land, your name's on the deed for property. They can't take that away, right? Same with a grave marker, your name's already on it. They're not going to take that away, right? And same with like a casket or an urn, you already paid for it. It's yours, right? So the things that you can prepay for, if you ever run into somebody like dead set on paying for something up in front, these things, not fixed, not variable costs, right? So now the reason why I go into that is because that's why there's such a big disparity between what goes, you know, what a funeral could cost. Because there's people that want a very, very basic funeral, 5 to 10,000. There's some people that want very extravagant funerals with thousands of people there. You know, you're probably looking at 40 to 50,000 for that, right? So at this point here, we got to get them to say who would take care of their final expenses. So Joe, if you did pass away tomorrow, who would be in charge of your final arrangements? Probably be Mary, right? Mary. Now, Mary, do you know how much a funeral costs nowadays? Right, and I ask her a question. She'll probably say like, yeah, like 10 to 15. And I'll say, okay, great, yes. Nationwide average, you're right, nail on the head, 10 to 15,000. Right? But just like your milk, your eggs, your bread, and your gas, every 20 years, prices are doubling. So 20 years down the road, when you're looking to use this, about 20 to 30,000. And I'm sure you guys remember, you know, what happened 20 years ago, right? And they'll be like, yeah, I remember, but they don't, right? So 20 years ago, prices were probably anywhere from like 5 to 10, right? So it's just going to keep doubling down the road, and that's due to inflation. You guys are pretty familiar with how inflation works, right? Every 20 years, prices double. Milk, eggs, bread, gas, materials used to make that computer, this laptop, this camera, right? So once I get them to realize, yes, that's what goes into a funeral, I tell them that this is actually the only area where our companies suggest you use whole life insurance to protect. Because that's a when, not an if, right? We're all going to die. We just don't know when. Right? You can even tell them, like, I mean, my dad told me this all the time. Drew, there's 2 guarantees in life. Death. Anybody know what the other guarantee is? Eric said taxes, right? Death and taxes, 2 guarantees in life, right? Except I'm from like a not great part of Pittsburgh, so I've seen people get around paying taxes. Never seen anybody cheat death though. Evil Knievel cheated death once or twice, but it got him in the end, right? So it's always going to get you. You just don't know when. So That's why I said final expense is a win. That's why, you want to have whole life insurance to protect that final expense. Right? Now, how we protect our final expense, right, is the freedom of choice certificate. Right? Making it super easy for them. Now, why I brought the freedom of choice certificate up is because when you're going through the needs analysis on the computer in eApp, the final expense protection video explains how the freedom of choice certificate works to everybody, right? So do you guys have any questions on final expense protection, how to explain it, how to kind of dig through it with them, get them to answer those questions? No? Good? Brian, we're good? All right, cool. Yeah, okay. All right. So that was the second concern. Second concern a lot of our union members have is protecting their final expenses. A lot of our union members are passing away, and their families didn't have $10,000 to $15,000 lying around for their funeral. All right, so what they did is they wanted to set up a program to make sure that they had that 10 to 15,000 taken care of, or that 20 to 30,000 taken care of. All right. The next concern a lot of our union members have is protecting their income. All right. So I would, if you're sitting down with Mary and Joe and they both work, right? You would just say, Mary, Joe, I'm sure you guys are relying on each other's income right now, right? And they'll probably say yes. So in the case where if one spouse is working and one spouse is not, use that, right? If Mary's not working and Joe is, I would say, Joe, I know Mary's not working right now, so, I know your income is very important to the house, right? He would say, yeah, it's super important, all right? Either way, you want to get them to agree that their income is important or that they share their income being important, right? So Joe and Mary, your income is very important to the house, right? I'm sure, you probably missed a paycheck before. There's maybe 1 week where you got sick and couldn't go into work, or you took vacation and you didn't get a paycheck for that week, right? But you guys figured it out. You were able to figure that part in your life out. All right. So the only way you're not going to figure it out, Joe, is if your paycheck's cut off forever, if you're not here anymore. Right? So income protection, Joe, would make sure that the next 3 to 5 years of your income was protected. All right. This will make sure that $3,000 every single month would come into the house to keep the bills paid, the food on the table, and the lights on. Right? Now, income protection, we're talking to them about it. You got to paint the picture of that one person not being there anymore. Does that make sense? Right? So if you watch the videos that are on eApp, they do a very good job of explaining income protection to them. And the way they do it is with the heartbeat, right? Now you can easily explain this to members as well. You can say, Joe, now Joe, you being the only one working right now, right? You're kind of like the heartbeat, the financial heartbeat of the house, right? What I mean by that, Joe, is no, your paychecks come in, right? And come in and then you spend them. Then they come in and you spend them. Then they come in and you spend them. Then they come in and you spend them, right? They're going to keep doing that up and down, up and down, up and down, just like your heartbeat, right? The only way that you're not going to have any income coming in or not going to be able to spend it is if your heart stops, right? If your heart stops, Joe, what else stops? Your paycheck, right? Your paycheck stops, right? So losing your paycheck, Joe, would be like a financial attack for your house, right? And the way you equate it to that heartbeat is because your heartbeat's never up and down, is never flat, right? If your heartbeat's flat, guess what? You're not alive anymore, right? Your heartbeat's up and down, up and down, up and down. Your paycheck and your money and your family is up and down, up and down, up and down, right? It's never going to be a consistent rate. You're never always going to have consistent money coming in and not have any negative. You're always going to be going up and down, right? So income is very, very vital to a lot of our families, especially with the demographic we're working with. They're very blue collar people. They're making anywhere from $3,000 to $5,000 a month to bring it into the home, right? Chances are a lot of that's going to go to the bills, and they're going to have a little bit, maybe $1,000 to $2,000 every single month left over that they're saving or going towards something else, right? So income is super important to people because that's what's going to pay for everything else. So when you're going over income protection with them, you could break it down with their unique situation right here, right? Now, what you should be using to find this information is that family information guide, right? If you know that on that family information guide, they told you have term coverage or they told you they have coverage through work, this is where we're going to spend it right here. All right, so Joe, I know you said you had $200,000 through State Farm, right?
Yeah.
Okay, perfect. So you got that for the income protection, and you said you had 100,000 through work as well.
Yeah.
Beautiful. Okay. So Joe, your income right now, what do you usually bring in home every single month, Joe? About
My bad.
six,
So $5,000 a month.
about $5,000 a month. Okay. You bring about $5,000 home a month, right? We multiply that. Let's say we multiply that by 12, right? That's 60,000 a year. Right. And then Joe, to protect the next 3 to 5 years, so we'll multiply that by 5, right? So over the next 5 years, Joe, you're a $300,000 asset to this family. If everything goes consistent, Joe, you're still working the same hours the next 5 years, you're going to bring $300,000 into your family. All right. So this is what you kind of want to protect. You want to make sure that $300,000, if you're not here anymore, comes into the house for the next 3 to 5 years. Good news is, Joe, check this out. You got $200,000 through State Farm and $100,000 through work. That's going to take care of all your needs here in the income. Right? You did a great job, Joe. You did a great job protecting your income.
So that's a good way when they have other insurance.
Mm-hmm.
Just be like, yeah, great job on that. That's going to cover this, but the rest of the stuff.
Exactly. So that's why I don't want you guys, you're going to run into people who have life insurance.
Yeah,
Yeah.
It's a 2 universal policies.
It's going to happen. People have life insurance before they see us.
Yeah.
All right. The thing is, you can't be scared of that. They're going to have it. What you have to do is spend it. That's the easiest way to get around that. Spend their life insurance. All right. Because I'm going to give you a good example here. So, Eric, let's say me and you, we're going to go to Speedway over there, right? And at Speedway, we need to pick up a few things. We got to get some milk. We got to get a loaf of bread, and we got to get some eggs, right? The wife's really on us. She's going to be mad if I come home without that stuff. All right. So me and you are going to go over there, and in my right pocket, I have a $20 bill, and in my left pocket, I have a $100 bill. I get to the register, and the total is like $15.17. Am I going to use the $20 bill, or am I going to use the $100 bill to pay for that? I will use the 20, right? That's the right answer to that question. Now, Eric, why would you use the 20 as opposed to the 100? Not to break the 100, right? You wanted to get into something, say something like, because what happens if you break the $100 bill? And then what happens when you get the change?
You spend it more.
You spend it, right? You spend it. So that's the same thing that's going to happen if they cash that $200,000 policy in for $30,000 for a funeral. They break the $100 bill, and then the rest of it just goes. It goes, right? So if you give them that scenario, that's going to nail it down in their head that you're right. If I die, my wife's going to see $200,000, and she's going to be like, okay, let's use $30,000 for this, and then let's buy a new car, right? All that money's going to go because you're not going to realize that it's not the full $200,000 anymore. It's $190,000 or $166,000, right? All that money is going to go. So let's put it towards something that you need. Use that $200,000 to take care of the income, and then use the freedom of choice certificate to take care of the final expenses, right? So spending their income, spending their money right there with the policy they already have is pretty easy to do, especially if you're in that scenario of going and using the $100 bill or the $20 bill. Right? Just remember the $100 bill theory.
What happens if, I talked to Vince about this because I had sits with him. What happens if they have the term, when I explain the term in whole, they're like, oh shit, excuse me,
Yeah.
they're like, oh crap, I want to go cancel my term. Do we do anything about that?
I mean, if it's with our company, we can, but if it's with another company, no, it's illegal to replace life insurance. You can't tell them to cancel it.
Right. But
Yeah.
what happens if they just want to because of the way I explained it? I won't get in trouble, right?
No, you'll be okay.
Is that
If that is the case, make sure that she gets approved for our policy before she cancels that one.
Right.
Because we have to make sure she goes through underwriting first.
Yeah.
You can't just guarantee your policy and have it go through underwriting and gets declined or gets rated or something like that.
Canceled on them.
Exactly. You got to make sure she can afford both for a couple months, right? Which is, it's a good way to do it as long as it's their decision to do it and not yours, right? But income protection, guys, you want the easiest way to kind of break down their income right here. And if you want to do it real simple, like I know our team does it super simple, and I just tell them like, income protection. All right. Then the third concern a lot of our union members have is income protection, making sure that if they don't come home from work tomorrow, that at least your paycheck does every single month, right? And typically our company looks to protect 3 to 5 years of your peak earning income, right? So Joe, if something happened to you, your paycheck would still come into the house every single month for the next 3 years, right? And you could ask them how much they make right there, because I know your team breaks everything down numbers wise right here. We do it after the needs analysis, right?
Yeah, I see how you guys do it.
I mean, it's the same thing both ways.
Yeah.
I'm putting everything more on them than myself,
I feel like we just, really the way that we do it, we get it to their head.
Yeah, I mean, I use the needs analysis. I build up the needs analysis in the computer system so much that when it shows them $200, that's what it recommends.
Right.
You don't go to Starbucks and say, oh man, I can't pay $5 for that latte. They're gonna be like, all right, go to the gas station next door then. That's what it costs.
Right.
You don't see anybody go into Starbucks and be like, hey, I only got $4. Can I get a $5 coffee? They're gonna be like, get the hell out of here. Sorry. We'll give you a cup of ice for $4. Here you go. Right. So it's got to be the same way with our company. That's why I show them that price, because it's what it recommends for them. But when we're talking about income with them and income protection, an easy way, like I said, to get across that it's a real thing is either make sure that they understand like their paycheck is the heartbeat of the home, right? And another very good way to sell somebody income protection is using what's called like the ATM close, right? So how much time we got? We're good. So Eric, if a quick example of this, like, so Eric, let's say down in your basement, you're going to put a brand new ATM in there, and that ATM is going to spit out $4,000 every single month, right? Now you have two options for ATMs that you're going to get. You have an ATM that is going to spit out $4,000 as long as it's working, as long as it's operating. Or you can get an ATM that's going to spit out $3,500 every single month, right? But the good thing about that one is it comes with a warranty that says if this ever breaks down, you're still going to get $3,500 every single month, right? Would you take the ATM with the warranty or the one without the warranty? You would take the one with the warranty. Even though you get $500 less a month, you would still take the one with the warranty. Why would you take the one with the warranty? More security, right? Because you know that if something happens, if it breaks down, right, you're still going to get that money.
So they're dumping $12,000 into buying a new one or fixing them.
Right. So unfortunately, Eric, there's no ATM in your basement. You can't just go out and buy an ATM machine, right? But if you think about it, you're the ATM machine in the house. Every single month you're going to go to work. Every single day you're going to go to work, right? And you're going to bring $4,000 into the house every month, right? The only way you're not is if you break down, right? At least if you have income protection and you do break down, your family's still going to get $3,500 every single month, right? So like I said, there's no ATM, but your wife would probably call you the ATM, right? So that's another good way to make something that's tangible, like an ATM machine, like everyone uses and pulls money out of, right, into something that's not tangible, their paycheck, right? Having that feeling of protection from the paycheck, right? So And like I said before, this is the most of the time where I spend their income, where I spend their life insurance already. So the reason why I go over the pie chart is to knock some of these areas off. So if they already have coverage through there, now you guys are going to have to practice that. You're going to have to go through it a bunch of times to know which companies sell which policies and things like that. But a lot of people just tell you like, yeah, I have $200,000 of life insurance at work to protect that. Okay, that's phenomenal. Great job getting that. Seriously, like never brag on their protection. Like, you got State Farm, that sucks.
Yeah.
Don't say that. It makes you look bad as an agent.
Yep.
You always want to compliment them on that stuff. You did a great job of getting that protection because that's going to cover this gap right here. But it looks like there's still 3 other gaps that we need to protect.
Yeah, that's how we run the POS. Great job on getting your foot in the door.
100%. 100%. So, do you guys have any questions on income protection? How to explain it? How to go over with them? I gave you like 2 good examples of like real world situations that you can tie into income protection.
I wish it was that simple to explain it on my team.
Super easy.
Like a whole page of just income protection.
I get it. If you just keep it simple for people right here, it's the same thing.
That's what I tried.
But I understand, teams do it different. That's why I wanted to explain it in a couple different ways, So anybody have any other questions on this? Anybody in the virtual world? Nope. All right, cool. So the next concern, or the fourth concern a lot of our union members have, is protecting mortgage or their rent, right? Most people's biggest asset that they own is their house, right? But unfortunately, until they pay it off from the bank, it's actually their biggest liability, right? So if somebody passes away, that mortgage company still is going to ask for that mortgage payment every month. They're going to knock on the door like, Mary, I need the mortgage this month. You owe us $2,500. Joe died. Oh my goodness. Sorry to hear that. Here's the bill. That's seriously what's going to happen. They don't care that you passed away.
I've noticed that mortgage companies also set people up with term.
Yep. Yeah, so you might run into this with mortgage protection. Some people might what's called this marker's all drying out. PMI, right? PMI stands for private mortgage insurance. Now, the only reason that you would have private mortgage insurance is, number one, if you put less than 20% down on the house, they make you get private mortgage insurance, right? Or if you have bad credit. Those are typically the only 2 reasons why you would have PMI on your policy, right? And once you pay off the principal, the PMI falls off too, right? So PMI, guys, is not insurance to protect the person. I want you to get that. I want you to understand that. PMI protects banks. Right? Because let's say that I'm going to go get a mortgage out on this house, and the mortgage is $200,000. Right? And I go to my local branch PNC bank, and I'm like, you know what, guys? I plan on buying this house. Here's my plan. Lay it all out for them. I'm like, I need $200,000 to pay this mortgage. They're like, okay, Drew, sounds great. You're approved. Here's your $200,000. Do you think that bank has 200 grand on hand to lend me right there? No, right? It's impossible for them to do that, right? So what happens is they borrow that money from a bigger bank, right? And when they borrow that money from the bigger bank, that big bank wants an insurance saying that they're going to pay off that loan, right? So what that insurance is called is PMI. That states that if this member or this person dies, the little bank doesn't have to pay the big bank back. You still have to pay the little bank back. The little bank doesn't have to pay the big bank back. All right. So PMI is not great to have, but you have to have it in certain situations. So,
well, real quick, would that be listed on their policy for it?
Yes. So when they get a mortgage, they'll also have like they'll see a mortgage payment come out, and then it'll be like another $50, $60 on top of it for the PMI. Yeah, typically it's for the whole term of the mortgage. Yep. And like I said, they'll never see any of that money. It's between banks.
It'd be like a 30-year term for a 30-year lease. Or
Yep.
mortgage.
Yeah, it might be that, or and then 2 years after they pay the principal off, it falls off. So it's not like a permanent plan. They just need it on it for that time, right? But this is one area really where you don't really have to kind of paint a picture, because they understand what their house is. They lived in their house. They understand that it's a very big asset to them. I mean, you definitely want to mention it to them, like, hey, Joe, if I were to ask you what your biggest asset you own, what would you say? They're going to say the house every time. And I'll say, Joe, you're right. Probably the biggest asset you own is your house. But unfortunately, Joe, until you actually pay that house off, it's actually your biggest liability. Right? So you're flipping their asset you're flipping their house from an asset to a liability right here. Right? So from what they thought was a good thing to something that they see is there's a little gap in coverage there. Right? So if they owe a mortgage, you can just ask them right here, like, Joe, how much you guys owe left on the house? 100,000. That's not bad. All right. So you owe about 100,000 left on the house. Right. So what would happen to the mortgage payment, Joe, that you're paying currently right now if you didn't come home tomorrow? Who would be paying it? Mary would be paying it, right? It'd probably be tough for Mary to pay that on her salary right now, right? Yeah. So either what she's going to have to do is either refinance the house, which is going to cost her more money down the road, or she's actually going to have to sell the house, right, and move. And it's still not a quick process with that either, right? So at that point, it turns from your big asset to your big liability, right? So really, you guys only have about 20 years left on it, which isn't too bad, right? So you can honestly see here that there's a big gap of area that you need protected. You want to make sure that if you don't come home, at least your mortgage is taken care of. You can live in a house. You guys have been here for 10 years. At this point, it's not a house anymore, it's your home, right? So we want to make sure that stays in the house. I can't think of a bigger, legacy to leave somebody than to leave them a house and property, right? Your family could live there forever. The only thing they got to worry about is estate tax is a couple grand every year, right? So mortgage protection, like I said, is something pretty easy to explain to them. It's tangible. They understand it. They live in it. They're in it. They're in their house when they're talking to you guys, so they understand where their house is. Now, the other thing you might have to get around here is rent protection, right? It works the same way. If someone has, they pay $1,000 a month in rent, it's 12 grand a year, right? Over 2 years, that's 24,000. Call it 25,000. All right, over 4 years, it's 50. So I usually project out 4 years of rent, 50 grand. All right, project out more if you want. Just know when you're going over the protection for them, income protection is typically going to be a 10-year renewable and convertible term, right? Mortgage typically going to be either a 30 or 15-year decreasing term, or accidental death. If they're young enough, it would recommend accidental death for them. If they're young enough, I would recommend accidental death to take care of this.
Oh yeah, for sure.
Because
I got it.
Main reason why is you're gonna keep paying that. They're gonna keep paying that mortgage payment, hell or high water. They need to live in that house, right? So over the next 30 years, you're gonna continue to keep paying it, right? But if you were to die, probably in the next 10 years, when you're still trying to pay into that, do you think it'd be because of health issues or because of an accident? Accident, right? So that's why they would recommend accidental coverage for that, right? So like I said, mortgage payment or mortgage and rent are pretty easy to explain to them. It's very tangible. They see the mortgage payments coming out every single month. They know it's there, right? Just remind them of it. What you really want to do with mortgage is number one, ask them if they have if they rent or own. If they own it, ask them what they pay into it every month, or not what they pay into it. Ask them what the balance of the mortgage is, and get them to realize that if something happens, Joe, you don't own the house, the bank does. All right. So anybody got questions on mortgage protection? Pretty easy, right? Okay. Okay. So Mortgage protection there, you got, let's just leave this as an example here, 100,000. Right, and let's just leave this up here for, I don't know, 200K. That's how much he makes over 5 years. Okay. So the fifth concern a lot of our union members have, all right, is protecting their kids' education or making sure that their debt is wiped away when they pass away. And I also wrote legacy up here because if they don't have kids or any debt, they can build a legacy for their family's future down the road, right? But most people you're going to see either have kids or in debt, right? I think like 60% of America is in debt, right? It's probably higher than that, to be honest. But child education and debt are two big things that most people get taken care of before they die. The only reason like these are not going to get paid off is if they die prematurely, right? Or like in my situation, my mom raised 5 boys, so we didn't have any money to go to school. She said, if you want to go to school, go get loans and work, right? So you can still do that. You can still do that to go to school. It's tough. It sucks. It took me 5 years to graduate, but I did it. You know, I wouldn't wish anybody to have to go through that grind, but it made me stronger as a person. It made me really self-reliant, you know? So, I mean, maybe I would recommend it to people. And that's not for everybody though, I'll tell you that. But college education is something that's very important to people because it's bettering the next generation. So the one question I always ask here is I say, Mary and Joe, how important is your kid's education in the future? And they're probably like, it's pretty important. You'll get a lot of people that'll be like, yeah, it's really important. I want them to go to school. You're also going to get some people who be like, they're going to do what they want to do.
Yeah.
Right.
One real quick thing. I don't know, just so you can tell them, or I'm sure you probably know, but like when they say like, oh, my mom or dad didn't pay for my child education, why should I pay for my kids or whatever? Because you will get that.
Yeah. Oh yeah. Oh yeah.
But the rebuttal for that, at least that I heard was, you know, if you could give them a chance.
Yeah.
Would you? And then they always say, yeah.
Yeah, we always say, here's what I say. I say, we always say at the company, you know, if you're not here, at least give them an opportunity to go to trade school or open up a business or, you know, go to a 4-year university. All right. So Mary and Joe, you know, I'm sure you want your kids to go to school, right?
Yeah.
If you say it like that, they're going to say yes. Mary and Joe, I'm sure you want your kids to go to school, right? Yep. Okay, great. Well, you know, what kids' education or debt protection, you know, protects is to make sure that if you're not here anymore, if you don't come home from work, that at least they have an opportunity to go to school or use that money to open up a business or go to trade school or do something like that to better themselves, right? Because Mary and Joe, you know, why would you send your kid away to go to school? So he can better himself, right?
Yeah.
So he can become a better person, right? This would be a way to make sure that if you're not here anymore, at least he has an opportunity to go do that, right? And Mary and Joe, do you know what it costs to go to a 4-year university nowadays?
Upwards of 100K.
Nail on the head, man. The nationwide average for a 4-year university is $100,000. Right? So with this 100,000, now you have 2 kids too, right? So it's about 100,000 per kid. If you weren't here anymore, this would make sure that, you know, $100,000 went to Billy and then $100,000 went to Sally to make sure their education was paid off. Right? I can't think of a better legacy to leave your family than to better themselves. You're giving them an opportunity, right? So when it goes to kids' education, you can break it down real simple for them. Like this shouldn't be too big of a long conversation with them. Yeah. You know how much goes into school? Yeah, okay, great. Right? And write it down for them. The whole reason we're going over this is to visualize their concerns in their areas. Right? So writing numbers up there is a good thing. Showing them what they need coverage-wise is a good thing. Right? Now, I do this because when I go into the needs analysis and it says the same exact numbers that I already wrote on the board, that trust factor is even stronger because they know I know what I'm talking about here, and then the computer reaffirms it. Then I just tell them, hey, this is what the needs analysis recommends for you. This is how much it's going to cost a month. Is that comfortable? They say no, and A, B, and C options. If they say it's comfortable, I just go right through the app. Keep it easy on us, guys. The e-app is designed for you to go click buttons and for them to show a number and for them to go, okay or no. That's like what it's designed to do. So the computer's designed to sell one out of three people just by showing that number what they need. You know, they didn't design that needs analysis for you guys to fly through it and to show nothing. All right. I get that. You know, it's a little tough to do right off the bat. It takes a couple of weeks to learn that stuff. This can be implemented today. Do you know what I mean?
Yeah.
That's why I teach it. That's why I teach the laptop close, because you can do it right then and there. You know, but once you have everything on here, and so that's the fifth concern. So sorry. Do you guys have any questions on like kids' education or, you know, debt? If they have debt, break down their debt. If they don't have kids, right? Let's say in this situation, they don't have kids, then I wouldn't even put child's education in there. I'd put debt or legacy. And let's just say they have debt. I say, you know, Mary, do you have any debt? Or sorry, Joe, do you have any debt?
40,000.
You got 40,000 in debt. Typically, they're not going to just tell you I got 40,000 in debt right there, though. They're going to be like, yeah, I have some debt. I say, okay. Now, is the debt on like credit cards, or is it on like the car loan or anything like that?
That's what I got yesterday.
She had 40 grand. She said 40 grand out the bat.
40.
Usually, most people are going to be like, yep, I owe 40 grand. Most people are just going to be like, yeah, I have some debt. I'm like, okay. So do you have anything like credit cards? And they're like, okay, what do you owe on your credit cards? Let's say it's like 3 grand. Okay, it's not bad. You have anything? Do you have a car loan or anything out like that right now?
My car loan,
15,000 on the car loan.
Yep.
Okay. Any kind of like hospital bills or college education or anything like that?
Medical bills, I got 6.
You got 6 grand in medical bills. Okay. Okay. Is that all the debt you got there?
My school loan's 10 grand.
10 grand on the school loans. Okay. Not too bad, actually. I see a lot of people with upwards of 100,000 for school loans. So you're not doing too bad, right? So, you know, just adding that up here real quick for you. 19 and 15 is 20 is well 24 plus 10, so about 34,000 in debt.
Yep.
All right. So if something happens to you, Joe, where do you think that 34,000 goes? You think the government just says, "Oh, you know what, Joe, you died, your debt's forgiven. Have a nice life."
People say it. They're like, "Oh, I don't have kids. Oh, it's not gonna go anywhere."
Yeah. So what happens is that $34,000 that goes to his estate. Now his estate's negative $34,000. Right? So now his estate's negative. And let's say Joe has, I don't know, $30,000, $40,000 in like IRAs and investments and things like that, liquid assets. All right, let's just say when he dies, he has $40,000 plus. Right? Well, his real net for his estate is only 6 grand. His family was thinking that they were going to get 40, but because they have to pay off the debt before they get the money, it's only 6 grand. Right? So you're going to run into some people that have debt, and they always think, you're right, Eric, they always think that their debt is forgiven. Yeah. Unfortunately, it does not work that way.
I just don't know how to answer.
Your debt goes with you. Your debt does not go with you to the grave. It goes to your estate.
She's like, no, I'm not going in the coffin movie.
And then if you guys remember from me going over the no cost benefits, right? The executor or executrix is responsible for all debts of the estate, right? So not only are you leaving $34,000 to your family, you're leaving your brother a $34,000, problem, right? Now, hopefully you have some money there to fix it, but right now it's a big liability. It's 34 grand here that you owe, right? So let's make sure that if something does happen, that's all paid off. So you can break down their debt with them right there too. Right? Don't be afraid to ask them questions here. They sell. Questions sell, especially if they know you're an expert in this situation. Right? They don't. If you build good rapport with them and explain like what you're doing, then they'll just understand that this is part of the process. But legacy is another thing. Let's say they don't owe any debt. Right? Legacy. All right. So, Joe, if you died tomorrow, I know you don't have any family and any brothers or sisters, but I know you got a bunch of cousins. Wouldn't you want to leave the cousins with some money? make sure that if something happens to you, that, they can go to an amusement park every year in your honor, right? Legacy is a little tougher to break down to people, but to be honest with you, you really shouldn't have to do it very much. But I mean, if you really want to get into legacy, like the main thing you want to make sure that legacy wise is mortgage. It's a house. That's a huge legacy leaving somebody, right? Legacy, this would go into like maybe getting a big term policy if they know they're going to, if they think they're going to pass away in those certain years. Like the way that wealthy people redistribute their wealth to their families is with life insurance. Do you guys know that?
Yes.
Right? So there's companies out there that will insure people for millions and millions and millions of dollars. And they might pay a couple $100,000 a year to keep that policy in force. But when they die, all that money goes to their family. So they're just redistributing their wealth. And guess what? When it comes out, it's tax-free. Yep. Right? So redistributing your wealth with life insurance is a smart thing to do. But number one, if it's a term policy, it's going to be expensive down the road, right? If it's a whole policy, it's going to be expensive most of the time if they're getting big amounts for it. And typically, you're not going to run into people with our company in those situations. You're just not. And like a lot of our members are very blue collar. Just for instance, like the lady yesterday said she made $34,000 a month. I said $34,000 a month. She's like, yeah, I got a lot of investment properties. I run this company and I do this on the side. I said, you're busy. I was like, what we need to do is we need to make sure that's all protected. All right. The good news is she had a lot of insurance through other companies. She didn't have whole life. No whole life. So I ended up getting her a plan to where whole life is all protected, right? She's going to build some value in it down the road. All of her kids are protected, and she has some accidental coverage.
How much was it?
I like 1,500 AOP, something like that.
You posted it?
Mm-hmm. Yep. Very, very nice lady. She already had policies with the company. They all lapsed. So it was a pretty easy thing to get right back on the books. But I still broke down coverage to her because her situation changed drastically from the first time we were out there. Right? So the one thing I don't want you guys to be afraid of right here is asking them questions, right? Because if they're not willing to ask that, they're not willing to answer the questions, you're not going to be able to help them effectively. If they're like, why are you asking me all these questions? Well, the reason I'm asking you these questions, Mary and Joe, is because these are the big concerns that your union wanted us to help you with. And if we break them down for your situation, we can show you where your areas of gaps of coverage would be. Right? And if you guys have everything covered, we'll be able to cross everything off. If not, you're going to see where you have some gaps at. Right? So like, I don't want you guys ever to be scared to ask questions here. And I don't want you guys to fly through this part either. Like this should be like maybe 15 to 20 minutes of going through them. The more time you take here, the less you're going to have to take time like going over the price of the benefits and explaining it to them. Because what we're doing here, guys, is we're I hate to even say selling life insurance. What we're doing right here is we're explaining life insurance based on concepts, easy concepts. We're not saying $30,000 the whole life for your funeral. We're saying final expense protection. We're not saying $200,000 to protect your income. We're saying income protection. We're not saying $3,000 every single month coming in. We're just saying income protection. Same with mortgage protection and kids' education. They're concepts so that it's easier for them to understand it, not just numbers. Now you're going to run into people who are very number-based and very analytical. They want to see those numbers. That's why I put them up there. But if you do a good job of painting the picture of income protection, painting the picture why they need the mortgage protected, they're just going to be like, oh, yeah, that makes a lot of sense, right? And the main reason why I have them visualize this and paint a picture for them is because, and I tell my team this all the time, people will buy things that they like, but they'll keep things that they understand. If they just see $200,000 of coverage for $35 a month, and next month a bill comes up and they're like, damn, do I either pay this $200,000 or do I pay for, the cable bill? Probably gonna pick the cable bill because they understand what the cable bill does for their family, keeps them entertained. But if they understand that they keep paying that premium for $200,000 and they die, their family's gonna get that money, it's a concept at that point, right? So they'll keep it because they understand what it does for their family, why it's there. Does that make sense to you guys?
Mm-hmm.
Right. So and then so they have questions on like kids education, legacy, or anything like that? No, we're good. All right, cool. So the sixth concern that a lot of our members have is affordability and being able to qualify for the programs. All right. So that's why we actually go through the needs analysis with you, make sure that you understand exactly what your family needs, and we'll see if you're able to qualify for it. All right. So that transition goes right into the needs analysis, and you go over needs analysis, right? The last thing I do before I ever like click off this screen or ever like erase the dry erase board or whatever, I ask them a very important question. I say, Joe and Mary, I'm going to ask you a very important question here. Joe, if you died tomorrow and you can guarantee that your final expenses, your income, your mortgage, or your kid's education was protected, what would you say is the most important to you? You would say income.
Oh, wait, no, yes, final expense.
Well, no, let's just say he has nothing here.
Okay, income.
You would say your income.
Yeah.
Your income protection. Okay. Why would you say your income protection, Joe?
Because it's a lot of money and I don't want to change my lifestyle.
Okay, so it's a lot of money. I got you. What does that money do for your family? Pays the bills. Pays the bills. Okay. And paying the bills is important because
I don't want them, like you said, they lose us physically. I don't know if you did, but in my spread, they lose us physically, but not financially.
exactly, right? So I didn't just ask him what was most important stuff there, right?
Yeah.
I asked you 3 or 4 questions on top of that
Yeah.
because I want you to explain to me why you think it's important. I'm getting you to sell yourself on it. Does that make sense? So we have to make sure that they are selling themselves on why they think it's important. So it's great, Joe, you picked income protection, right? Why would you pick it? Because it protects your paycheck. It's good. But Joe, what does your paycheck do every single month for the family? Pays all the bills, right? Right. So if you weren't paying the bills, who would be in charge of paying the bills? Mary, right? And Mary's not working right now, so it'd be a little bit tough on her, huh? All right. So I get it. Income protection, very important, Joe. And I circle it for him. And I say, Mary, same question to you. Mary, if you died tomorrow and you can guarantee that your final expenses, the income, the mortgage was paid, or your kid's education was taken care of, what would you say is the most important to you, Mary?
Final expenses.
You would say final expenses. Okay. Why, Mary? Why would you say the final expenses?
That's the first, payment that has to go out right away.
You're right. Because you guys probably don't have 20 grand laying around in your bank account right now, do you? No. Okay. And then if you did, probably was not there for, final expense protection. You're probably saving up for a cool vacation or something like that, right?
Yeah.
So, I mean, that's, making sure that your final expenses, making sure it's not a burden to anybody down the road, right? So, actually, guys, most of our members kind of say the same exact thing. They want to make sure that their final expenses are protected so it's not a burden to anybody. And they want to make sure their paycheck keeps coming into the house every single month, right? So you guys are right along the lines of most people's thinking, right? So in order to make sure that, you guys have the rest of the program taken care of here, the last benefit they have set up for you is your needs analysis, right? And what I like about the needs analysis the most is it takes into account everything you have going on in your current situation. It's going to let you know if it sees any gaps in any coverages. If it sees some gaps, it might recommend some things. If it doesn't, it won't, right? And then based on those recommendations, we'll see what we're able to help you with today. Does that sound fair?
Yep.
All right. And then I go right into the computer, right into the needs analysis, plug everything in, right?
You got to keep the report, right?
When I'm going through the needs analysis,
Yeah.
I just ask them questions.
Oh, okay. I messed up yesterday to deal with that.
But the one thing I want you guys to get across too is making sure that you guys should not fly through this part. You got to sit here and go over this with them for 10 to 15 minutes.
Slow.
Don't be afraid to use their numbers, right? And if they have life insurance, spend it. Spend the coverage. All right. So let's say they have $50,000 in a whole life. Great. Knock their final expenses out of there. They still have other gaps though. Now, keep in mind too, you're not going to run into every family that has, final expense protection. You might run into a family who is a single person. If it's a single guy, right?
It depends on their income.
Right? So that's what we got to go into next. That's the next thing I want to go over, guys, is like situations here. So if you get into a situation where you're dealing with a single person, they don't have kids, they rent, there's no one relying on their income, right? The only concern at that point is final expense protection. So income, I mean, you could go through it with them, but if no one's relying on his income, it's not going to be important to him. Don't beat a dead horse. Right? Same with mortgage or rent. If he's a single person, no one's living in his house. If he stops paying rent, who cares? The landlord's going to be mad, but who cares? Right? Same with kids' education. Don't have any kids yet. You might have debt. You can go over debt with a single person, right? So more or less, it's more about the final expense protection for them. And just know when you're showing a single person final expense protection, you want to show more coverage than they really need, right? Because we're going to build value in the program with them. So if it says they need 30,000, I'll show them options of 150, 150, and 30, right? Because they're not going to need 30,000. They might need it now. They're going to need 60,000 because they're only 20 years old. All right, so projecting that out for a single person is there. Now, you're also going to run into situations where you're sitting down with people who are retired, seniors. It's almost the same exact thing. No one's relying on their income. They're both retired. If either one of them passes away tomorrow, they're okay. Either Mary's getting some of Joe's pension or Mary's getting Social Security, right? They'll figure it out. They'll be able to live. They might not be the same lifestyle they're living right now, right? But the liabilities aren't there. There's no kids in the house. Income protection is like super important if they have young kids in the house or if they're, middle-aged and they're still relying on each other's income, right? But if they're retired or there's no one relying on their income, it's not a big concern, and you can, I visually show them that. I cross it off like that, I cross off the kids' education, boom. So Joe, it looks like right now, you only got one need for coverage and to make sure your final expenses are protected. So what we're going to do is go through this needs analysis to see what it would recommend for your situation. So especially with seniors, the same way, right? With seniors, though, you're going to have to pitch on concept way more than price because a senior, the policy is going to be expensive for them. The numbers are going to suck. It's never going to be a good, friendly number for them. It's because they're older. You got to remember life insurance is based on two things, your age and your health. The older you are, the more unhealthy you are, the more expensive it's going to be. So if you're running into, two 60-year-olds or two 58-year-olds, their concern is way different than if you run into a 22-year-old or 35-year-old with two kids. Just know that not every single one of these you're going to be able to go over with them, So my advice there is don't make yourself look foolish and go over them anyway. You could briefly talk about them, but don't break it down for their situation. And at the end, if all these are knocked out, I'm not going to ask them, Joe, if you died tomorrow and you can guarantee that one of these was protected forever, what would you say is the most important? Because there's only one on there, right? So you would say, Joe, looks like from right here, it looks like, the final expense is the only area, that you would need, some protection in. So we're going to go through the needs analysis with you right now and see what I would recommend for your situation. All right. Or, if you guys are doing it, you probably just break down A, B, and C for them right then and there, So with seniors, though, what I wanted to get into with seniors, because and you guys are going to run into this a little bit. Like their needs are different than normal people's, especially like if you're dealing with our union members who have, pensions set up for them, things like that, right? They're always going to tell you, oh, I don't need life insurance. I have it through work, or I got a pension set up. My wife's going to be good once I die. Down the road, yeah, they'll be fine. But in that exact moment, no. Because they don't have 20 grand laying around. They might have a pension that comes out when he dies. Mary might get some of that pension. She's not going to get the full amount, though. She's going to lose money there, too. Yeah. Right? So just know that when you're sitting down with a senior, it's really going to recommend anywhere from probably the most 30K, but probably 15,000. That's what the needs analysis will recommend for them. All right, and depending how old they are, 15,000 might be $200 a month. Right, and in a lot of people's mind, $200 a month, if you do it, it's 2 times 12 is 24, so about $2,400 a year. So if they pay it for, I don't know, 3 years, basically, they almost put, not 3 years, 12 years. They put into it for 12 years, they'll pay about 15,000 into it. So if they do the math's not really always going to work out for them. But you got to avoid the math, you know? Yeah, they're doing it in their head. The way to avoid the math is to sell based on concept, on the concept of the freedom of choice certificate, right? Yeah. Right? And this is what I'm going to spend like the last 15, 20 minutes on with you guys, is the freedom of choice certificate, okay? So the freedom of choice certificate is a very, very valuable tool that we need to use. And we're the only company that has this. There's no other company that makes the claim this way, right? And the reason why we designed it is because the ease of use for it, right? I don't know if you guys have ever had to go to a funeral home before or ever work through that process, right? But when you walk into the funeral home, the first question the funeral director asks you is, did your loved one have life insurance? Right? And of course, you're going to say yes. Yeah, they did. Now, the next question he asks is how much? Great, I'm glad he had life insurance. How much life insurance did he have? Depending on what you tell him at that point, that's how much you're going to pay for that funeral. Right? It's like going to like a used car lot and going, hey, I got 20 grand right here. What kind of car can I get? You better believe every single one of those cars in that car lot is going to be 20 grand, whether it was higher or lower point. Because that's what you told them you have. And most people, what they do when that process happens is because they're so flustered and they just want to get it done with, they bring a life insurance policy into the funeral director's office and they say, here's his life insurance policy. And all the funeral director does is flip that first page open and he sees how much he can take. If he sees 50 grand, guess how much you think that funeral's going to cost?
50 grand.
50 grand. He's going to pull that big book out of the bottom with all the nice caskets in it and show you the $20,000 caskets. Meanwhile, he has another book in here with $5,000 caskets and $10,000 caskets, right? So this is a reason why we designed this, so that our members don't get taken advantage of. It's the most important part in their family. Like, it's the worst part in their family's life. They just lost their best friend of X amount of years. No one's thinking straight. Nobody, right? So this certificate makes sure that, number one, you can negotiate the cost of the funeral with the funeral director. So once they put the cost of the funeral on the back and they sign it, they give that certificate and the proof of death forms to the funeral director. Once the funeral director has those forms, he's going to call that 1-800 number on the bottom. He's going to talk directly to our claim department. Our claim department from that point on is going to handle everything. They're going to send out one check directly to the funeral director, and then the next check's going to go back to you as the beneficiary in a 3 to 5 day period, lump sum, tax-free, to wrap up any other concerns, right? So make it very, very simple and easy for our members, because it's the worst time in a family's life, right? Number one, and we're giving them a sense and stability about the program, so they don't have to throw money at problems to get them to go away, right? Now, with the freedom of choice, guys, like, I don't know if you guys have ever had to go through a funeral process, ever had to plan one, right? But it's not a fun process. It's not. It sucks. The one thing about our company that makes it easy is they don't have to file the claim paperwork. Like, the policyholders don't really have to call our company. If they give them the freedom of choice certificate to the director, the claim's being processed. They can use that next 3 to 5 days to start the grieving process, right? To get all the people that have to come to the funeral together, right? It's a quick 3 to 5 day process where there's a lot going on and not enough time to do all this stuff. So main reason why we came up with this is the funeral director typically wants paid when? Do you know when the funeral director wants paid for that funeral service?
Right away.
Right away, right?
Yeah.
They typically want half up front.
Yeah.
So If your funeral costs 20 grand, they want 10 grand that day. He's not going to start this funeral process until he gets 10 grand that day. There's many people who have their loved ones waiting for 3 to 5 weeks. I don't know if you guys have ever seen a body that's been waiting for 3 to 5 weeks. Doesn't look the same, right? So that 3 to 5 day period is a lot quicker than 3 to 5 weeks, because the funeral director, he's going to make that claim, and a check's going to get sent directly to him for everything that you negotiated, not half. So normally, if you were going to pay for a funeral and it was 20 grand, you would need 10 grand down that day, right? And then guess what? Within 60 days, he wants the rest of that 10 grand, or he can really charge your family up to 20% interest. It's a lot of money, right? Because it's basically like a loan. He's creating a loan. He can create his own terms for that loan. It's not getting it through a bank. That's his office there, right? And keep in mind, guys, I'm not saying that funeral directors are criminals. I'm not saying that, right? They have to make a living too. Like, people are literally dying to get into their business, right? So they have clientele. Every funeral home is different too. And there's no McDonald's menu board that says cremation's much, funerals this much, right? They base it off of what they see. So if you show them a big number, they're going to make it a big number. That's why we designed that certificate. So a lot of people, that if you explain the certificate right, they're not going to worry about what it costs, because they have the freedom of choice for it. It gives them extra options. It makes the back end situation not as bad. And I could tell you guys from experience, my brother passed away 2.5 years ago, had life insurance with our company. Our company paid my family $350,000, right? My sister-in-law at the time, when it happened, extremely distraught, right? And she still had to go into the funeral home, say the funeral director and my husband had life insurance. Luckily, I was there to help her with this process, because I've done it before, right? So I walked into the funeral director with her, and I told her, I was like, here's what he's going to say. He said the exact same words I told her, right? We sat in his office, and he gave us a bunch of different books to look at price-wise. And I told her name was Sarah. I said, Sarah, do not tell him how much he has, because he's going to try to ring the price up, right? We ended up paying about $17,000 for the funeral, right? I have a really big family, right? But at that point, that was all taken care of for her. She didn't have to make any claims. All she did was fill out the proof of death form, and fill out the form that said how much the funeral director was going to get, and signed it. She gave that to the funeral director. She had 12, and the next day, because he had 30,100 of whole life. Next day, it wasn't next day because it was a Saturday. On Tuesday, she got a check on her porch for the rest of the $23,000 to wrap up all the other costs, right? So the great thing about that, guys, is the fact that, 13,000, whatever. I'm bad at math. The great thing about it is she didn't have to make a claim. She used that next 3 to 5 days to grieve to start the process, right? And then he also had a big term policy, right? And with that term policy, it can be paid out in monthly installments or straight lump sum, all right? Now, her brother, so my sister-in-law's brother, right? Brother-in-law, I guess at that point, he's a financial advisor, right? So he knows how to use that money to make more money. So I told her, I said, hey, here's a smart thing you should do. Number one, pay off the rest of the house. Number two, give the rest of that money to your brother. Let him grow it for you so that it grows down the road, and it can give Isabella and Nick Jr., money for school, or you can just keep using it to pay rent and stuff like that. And she's been very well off since then. She's a NICU nurse. I don't know if you guys know what that is. It's like natal intensive care, like very, very small, like premature babies. So she deals with death on a daily basis, right? So it affected her so much to the point where she didn't go to work for 6 months. The good thing is she didn't have to, because she had income protection coming in from his dad, right? So just keep in mind that $300,000 is never going to bring my brother back, never. But what it did is it gave his wife time to figure things out, right? That's what I want you guys to realize, that like this money is never going to bring anybody in their family back. It's not designed to do that, right? It's designed to give them sense and stability about themselves, and it gives them time, right? It gives them time to figure things out. All right, so do you guys have any questions on like the freedom of choice certificate, how to go over that, how to explain anything in the pie chart, how to paint the picture?
So if, oh,
No, you're good.
um,
Tasha just popped on the screen. That's why I looked.
if someone like, if I'm explaining the freedom of choice certificate and they're like, what if we want to negotiate price? So then they would just write down, I hereby assign the amount of, then they put in 20K, let's say,
Mhm.
and then that's all like they would do. They'd call the claim specialist, tell them it's 20K, whatever, go about it.
Yeah. So what they would do is they would sit in the funeral director's office. They would negotiate the price. They put the price on the back of that certificate, right? And then they sign it at the bottom. Now, there's also what's called a proof of death form as well that they would have to fill out. It's not too difficult. It's like 4 sections. They just need like name, social, way they passed out, death certificate, that type of thing. It's pretty easy. Once you fill those 2 things out, you give all that to the funeral director and he starts the claim process. So nothing really after that, just your money, plan the funeral, and like it's going to be like tough. Once you guys make your first death claim, this is going to become really real for you. Like you might not think it's a real thing now, right? Your belief might not be there right now, but there's going to be a certain point where you're going to make a death claim. And it's going to become really real. Like if one of your members calls you and say, "Hey, my brother passed away. I need some help making this claim."
How do we do it?
You basically have to just call home office with them and tell them they need to make a claim. Tell them to fill out the paperwork, that type of thing. Your manager will walk you once it happens. That's when the business became real to me when I made my first death claim. It was, and the crazy thing is, I made a death claim on, it was like a 63-year-old person. The lady's husband passed away, and I ended up getting a call from her brother, who was the contingent beneficiary for the policy. And the main reason why I got a hold from the brother is I actually sat down with the contingent beneficiary and he got the policy too. And he remembered, if anything happens, call me. So I got in touch with him before I got in touch with the wife. And he let me know that it happened. So immediately I called the wife and figured it all out, But the whole business of life insurance and the whole industry, it's based on belief. It's based on your belief in the company, your belief in the product. Right? If you believe that it's there for them, they're going to see that belief too. Because these people don't care how much you know. You can explain this till you're blue in the face. But if you don't have a reason why you're explaining it, if you don't care about them, if you just see them as a number, they're going to be able to smell that on your breath and they're not going to buy anything. Because they just see you as selling something or pushing something. But if you're realistically helping their family and showing them, hey, if something happens, Joe, this is going to be due. This is going to be due. This is going to be due, and this is going to be due, which is important. This is the most important. Let's take care of this right now. You can always come back and take care of these other things too. And what the unions want you to do is get your foot in the door, but keep it as comfortable as possible too. Right? What I want you guys to remember when you're going over this is use words like problem and concern. Right? The big problem was that a lot of our members were passing away and their income wasn't protected. There was a big concern that, a lot of our members are passing away and their mortgage was still owed.
Major concern. The next major concern.
Exactly. Major concern, a huge problem. Right? So this all really stems from the list of concerns. Right? So it's not like I'm bringing this from another script. It's in the script. Yeah. We're just visualizing it in the script. That's all. So like I said, I like to give you guys a little bit of time here. Got about half an hour or so to ask questions or ask me anything you need. If you guys don't have questions, I'll let you out early here. But other than that, I went over everything I needed to go over with you guys today. Hopefully you learned some things and can use this stuff to paint a better picture, because that's really all today was about, is painting the picture for them, going over concerns, right? But do you guys have any questions? And Eric's good. He's here in the office. He can ask me questions anytime. Brian, any questions, man? Brian's my brother's name too, man. Spelled just like yours is, B-R-Y-A-N. Tasha, you ladies good? Okay, perfect. All right, well, appreciate you guys hanging out with me here today. we can, this is all being recorded, so we're able to, upload it for you guys. You can take a look into it some more. You guys have my phone number. If anything pops up, shoot me a question. If you have, shoot me a call, questions about anything I went over, or how to explain it down the road. Shoot me a call. But like I said, the best way to do this is just to practice it over and over and over and over and over again. And just keep in mind, you're not going to run into a situation where all of them are always going to be there every time. It's going to be unique to every family. That's why we do it. All right. No other questions, guys? Nope. All right. Thanks for hanging out with me. Enjoy the rest of your day. Let's get out there and protect some families. All right.